Welcome back to Rich Dad Stockcast. I'm your host, Denney, and today we're breaking down one of the biggest misconceptions in all of investing, the idea that you can only make money when the market goes up. Now, the wealthy know better. They make money in all three market conditions, up, down, and even sideways. And once you learn how, it changes everything about your financial future. And to break this down, I've got Rich Dad expert Andy Tanner with me, someone who teaches everyday investors how to profit no matter what the market is doing. And before we dive in, make sure you go over to stockcastbonus.com, grab your free investing tools. If you want to stop guessing and start using strategies that work in every market, start there. Andy, welcome back to the show.
Del, thanks for having me. This is an easy one. So this is going to be like falling off a log here. This is so easy. Cash flow is, well, that's the name of our academy, Cash Flow Academy. So this is what we do. So this is a piece of cake.
There we go. Speaking of piece of cake and something easy to do, stockcastbonus.com. What do our listeners receive when they go there?
Right now, we've got our ebook for free, Power 6. And it really, I have people come a lot say, Andy, how do you approach your wealth? Do you have rules? What are your procedures? What do you do every day? What are your SOPs? What's your standard operating procedure? And that's what the Power 6 is. My wife and I meet every week and, look at where we want to go from where we are and where we want to be. And we make a plan with it. I just show people how we approach it. And it is it's a life changer, but I'll let people decide for themselves. The best news is free. So download it, read it. And I think people will have the epiphany. It's like, wow, this is a really good system on how to tweak the 6 numbers on my financial statement to my benefit. So there you go, stockcastbonus.com.
That's a fantastic share right there. All right, so let's start with the problem as we kind of frame this episode here. Why do most people think that you can only be profitable when the market goes up? What are they missing? Why do we only think we make money when the market goes up?
Well, capital gain is when you buy low and sell high. And that's pretty easy concept for people to understand. I buy something low, I sell it high, there's a profit in the middle. So they're attracted to that. And the other reason people are attracted to that is it eliminates work. If people could go back to the Garden of Eden, they would. When you read the Bible, and I don't know, I probably get in trouble. You can't disagree with the Bible, I guess, but it lands down work as a life sentence, as if it's a curse. In other words, when they kick Adam and Eve out of the Garden of Eden, they say, you'll toil forever now, right? By the sweat of your brow, you'll earn your bread all the days of your life till you return to the ground. And they went from this perpetual utopia to a life of work. And work was seen as a bad thing or a penalty, right? I want to quit my job. I want to retire. I don't want to go to work today, right? I don't want to work. So most people look at work as a bad thing. I don't look at work as a bad thing at all. I look at it as an opportunity. Work, there's a book by Jonathan Haidt called the Happiness Hypothesis. He talks about flow state. That's work. When you're in flow state, you're doing work. It just doesn't feel like work because it's so fulfilling and so gratifying. So I will pull an all-nighter sometimes because I have a deadline. Those are the bad ones. But most of the all-nighters I pull, and my wife walks in, in the morning, and I'm sitting there all night in my office, she just knows I was in flow state. I was loving it. I was absolutely in the flow state, loving it. So work, when you eliminate work, that's why people think buy low, sell high is good, because I didn't have to work. I just bought something low, sold it high, I didn't have to work. Well, if you talk to Warren Buffett, he will tell you in his reports, which are now very precious because he's not going to do them anymore. He says operational earnings are most important of all the GAAP total numbers, of all the generally accepted accounting principles total numbers. Operational earnings. Now, what does that mean, Del? It means work. You got a nice operation. Things are operating nice here. Good looking operation you got here. The earnings that come from the work that is done will be consistent irrespective of the value of the business. So take Dairy Queen, for example. Dairy Queen's part of Berkshire, so I guess you could own it if you own Berkshire, but let's just take Dairy Queen. If Warren Buffett woke up in the morning and saw the market crash, that would not inform him on Dairy Queen's value. What would inform him on Dairy Queen's value are people buying dilly bars or not. Is the work we're doing supplying cash for us? So the beautiful thing about Geico and RC Willey and See's Candy and Fruit Loom Underwear and Dairy Queen, all these companies that he owns wholly, not shareholder, owns the whole cockeyed thing, they have no price. So he's making money on those every year, and there's no price to go up, down, or sideways. There is no price on those. That is true investing, business ownership. So if you go on CNBC, they're going to say, what's going up today? Is NVIDIA hitting a new high? Right? Oh, what fell down today? Right? Price, 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 price. But it's really, they're not talking about the operational earnings that are made. So, maybe we do this before the break, maybe after, but let's say, I get these Zillow reports in my email, and, it shows the single family houses that my wife and I own. And they give me a report of the price. It kills me because it's meaningless. Oh, the price of this home went up, price went down, price went up, price went down. And it's meaningless to my life, absolutely meaningless. Price stayed the same, meaningless. What is meaningful is the rents that come in and any debt that I'm financing on the properties. And as long as the rents are higher than the debt, that's cash flow. And I'm doing work. I'm having the money work. I'm not buying low and selling high. I'm providing housing. I'm providing energy through ExxonMobil. I'm providing phones through my shares of Apple. I'm providing beverages through my shares of Coca-Cola. What Buffett calls the lowest level of participation in business. You're still working, but you own the work. So that's how you make cash flow up, down, or sideways. You focus on earning from the work that was done and the value that was provided, not fluctuations in what they think the golden goose costs. Said nobody, I'm going to buy the golden goose low and sell it high. Said everybody, I'm going to buy the goose that lays golden eggs, take it home, cut the price tag off, and let it lay eggs and make me rich. And if the goose lays golden eggs, it's going to produce earnings whether the price of the goose is up, down, or whether it stays the same. So it's making that shift from buy low, sell high mentality of CNBC to what work is being done and what is the value of that work in terms of profit that can come to me as an.
That is such a great way of looking at that. Now, I think probably you're talking about before and after the break. After the break, let's talk about some, getting more tactical. But I still want to dig into the problem a little bit. And this is a loaded question because I know I'm going to put a quarter in you and watch you go here. Why does traditional investing only teach people to make money in bull markets? And when I say traditional, I'm thinking 401ks. What is Wall Street not telling the average investor?
Yeah, you put a nickel in that for sure. Look, Wall Street, why? I'll throw that back with a question. If you go to the SPIVA report and you just Google SPIVA, right? Actively managed funds versus the S&P, right? S&P 500 versus the actively managed funds. 90% of them fail to beat the S&P. Why is that? Well, the reason is the reason they can't do it is they're just getting the market average minus fees. So if you're just getting the market average minus fees, you can't beat the S&P because you're meeting it minus fees. So they don't want people, they absolutely do not want people to be educated in doing this themselves because their game is assets under management, where they want people to believe that they can't do it themselves. They want people to believe that, no, you have to give your assets here and let us skim the top. Wall Street they're not good at investing, or 90% of them would beat the S&P. They're just not good at it. They can't beat the average. Why? It's because their fees drop the return on the fund. It's that simple. So that's why they want you to think about it buy low, sell high. because that's their lifeblood, is your ignorance. Those aren't asset management fees. They're ignorance fees. That's what they are. They're charging you for not knowing how to manage your own assets. Assets under their management, they get paid for. Assets under your management, they don't get paid for. So obviously they're going to say, look, your 401k should be designed as a buy low, sell high vehicle. And if it grows at 4%, you withdraw 4%. But they look at it as they have mandatory withdrawals where you liquidate those assets to pay your taxes. And they look at it as assets paying for expenses, sell the asset, liquidate the asset to pay expenses, and hopefully have enough to last you before you die. They don't look at it as asset column, then up through the income column, then out through. The problem with a 401k is most of that money is liquidated by the sale of the asset to pay the expenses rather than the asset generating income to pay the expenses. That's a huge difference. But if they don't sell you on that fact, they're not going to get your money and they're not going to get their fees. And if you understand financial statements from the book Rich Dad Poor Dad, that's pretty easy to see. Look at the cash flow pattern. Asset, sell the asset, pay the expenses, less asset now. I'm selling off my geese because they're not laying eggs fast enough. Whereas if you compound truly in the number of assets you have by reinvesting profits, then you have cash flow independent of the price tag on the goose's neck. And that's the theme of your podcast today is how do you make money up, down, and sideways? You don't play that game. You walk away from that game and say, look, I'm just going to make money on the value that I give to the world through the work. And so work, it's called earnings that denotes earned money, not gifted money. Capital gain denotes gaining money, to get gain, to use the scriptural phrase, to get gain. To get something for nothing, to get gain, rather than to earn your keep. Make money the old-fashioned way, we earn it, right?
There we go. I love it. Could you imagine if on your 401k statement, instead of just fees, it says ignorance fees? You think that might change some things?
If you want a little insight on that, you might see, a really small management fee or some type of administrative fee or a statement fee. Fidelity has a fee where they charge you, I think it's $25 a quarter or $100 a year for statement fee. Like it costs $100 to send you a statement. Come on. But that's what you see. And so you look at that and you say, okay, well, there's my fees and they're not that bad. What you never see the expense ratios. You never see them because they're pulled out before the total is put on there. So if you look at you're in a fund and you see how much the fund grew, you don't realize that the fee's been deducted there already. It's nowhere to be found. Now, if I think it's called a 405A or, whatever, you got to go to your human resource and they'll give you that and that'll list all the different expense ratios separately. But most people never look at it. And if they wouldn't know how to read it if they had it. So the 401k statement, the law doesn't require them to show the true cost because it's been deducted before the number is even printed on the statement. And the nice thing is they get to say, well, here's your fees. So you think it's comprehensive, but it's not.
Yeah. Just $25 really is the huge expense.
Yeah, expense ratios are yanked. And some expense ratios are small. Some of them are like 0.05%, right? But some of them are 0.5 and some of them are like 2.5. So it's up to the investor to learn that stuff. It's not my job. I'll teach them if they want to, but I'm not forcing anyone to drink the water.
There you go. It would be crazy if you saw instead of statement fee, ignorance fee, if they just blatantly said that.
Yeah, anyways, here's your ignorance fee.
Here's your ignorance fee this quarter. All right, let's do this. Let's go to break. Listener, if you've ever made money, only when the market was rising, you're not alone, okay? But you're also not operating like the wealthy. So when we come back, Andy's going to walk us through the exact strategies investors can use to generate cash flow and profits when the market goes up, when it goes down, when it goes sideways. And don't forget, head over to stockcastbonus.com, grab your free resources. If you want to build a real system for consistent returns, that's where you'll want to start. So stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it. and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad Stockcast. Let's talk strategy. Andy, walk us through how someone can actually make money up, down, and sideways in the market. So let's start with the up market. How do investors maximize gains responsibly? Like, what strategies help people grow without overexposing themselves?
So to me, there's a couple of ways you could think about this. I'm not a buy low, sell high guy. I'm just not. So, is there a different strategy for me when the market's up, down, or sideways? No. I'll give you an example. I use ExxonMobil all the time because it's such a beautiful trade. Exxon has increased their dividend for almost 40 years in a row. So if you were to chart their price, it's all over the place, right? If you chart their dividend, it's like this since I was in high school. So, why would that be unattractive? And that upward slope is consistent and has not retraced since I was in high school, which is a long time ago, by the way, a long time ago. And so, when you say, well, is there a special strategy for up, down, sideways? Well, not there. There isn't. Where's that money coming from? Earnings from the business. They divide those earnings among the shareholders. So people are going to say, well, dividends are 1%. They don't keep up inflation. No. Dividends benefit from inflation. You buy Exxon at 40, like I did, it's paying $1 a quarter now. That's $4 a year. That's 10% just on the dividend. And that's before we start selling covered calls or anything else. So there are certain strategies, whether it's the call writing or put writing or dividend or whatever, it up, down, what do I care? Sideways. I'm selling insurance and I'm collecting money from giving value for insurance. So I really don't care that much about up, down, or sideways, right? Especially if I'm doing it intelligently. Now there's another part to buy low and sell high that is worth looking at. One of my dear, dear friends, I just love him as a human being, is Than Merrill. And he's got a wonderful fund, a couple of $1 billion in it. He's a real estate guy. More importantly, he's just an incredible human being. And one of the things he did before he got in the fund business is he did 2 seasons on Flip This House, where they'd film him and his team, and they're all ridiculously handsome. They look like they walked off the set of The Young and the Restless. They're all handsome dudes, and they go flip these houses for people, young and playing volleyball on the beach, and it's like Top Gun clips. And so he'd flip houses. Well, that's buy low, sell high, but it does have the element of work. It's forced appreciation, which is really real estate redevelopment. What is the difference between someone that sees a plot of land and goes to Home Depot and gets all the materials to build a nice house, and another person sees a plot of land with a lousy house and goes to Home Depot and buys a bunch of materials and redoes the house and sells it? So development and redevelopment are not that far apart. Well, Than, he developed a system that was flipping about 100 houses a year. Now think about that. You got to find it, you got to finance it, you got to fix it, and then you got to flip it. And you're doing about one every 3 days. And you know how hard that would be to buy a house every 3 days and average that out for 100 houses a year, every 3.65 days. So that system is a cash flow system, because he's got a business that does redevelopment. That's a lot different than the spec home, where a guy buys the house hoping to flip it higher with minimal forced appreciation, with very little of forced appreciation. So that element of work is still there. Well, there are stock traders that can do the same thing. There are stock traders like Noah Davidson is a good example of this, who they do like to buy low and sell high, but they do it within a system where they're educated and they're doing some work every day, figuring that stuff out. I do less of that. I like an iron condor once in a while. I like, broken wing butterflies. I love a long call in the VIX when it's in the teens long term, because you're going to get that spike. I like those trades. Don't get me wrong. I like those trades. I like to hedge and use futures when we're in a downturn.
Well, let's
core.
I was going to say, finish that thought, because I do want to talk about down markets here. But at your core,
yeah, but my core want dividends and premium. At the core, and 1% is enormous, as Warren Buffett knows. Over a lifetime of investing, if you look at the difference between 10% and 9% on 10 grand, it's millions of dollars. You get more long-term benefit in that last percent. It's about 40% of your total over investor's lifetime, just 1%. Well, if you have a 1% fee, you're giving that to Wall Street.
It's wild. That's wild. Let's talk about downturns. I think a lot of people are unaware that you can make money when the market goes down. You can protect yourself, and you can also profit as well. So can you tell the investor that's new to this, that only thinks, I got to invest the 401k, buy low, sell high? How do we make money? How do we protect ourselves? How do we profit when the market goes down?
Well, part of that's insurance. I mean, let's say that my house burns down today. Well, that would be lame. I'd probably lose some family heirlooms, maybe some nice things that I cared about. But in reality, I'd just get a check for the sum of what I lost. So I would make money on this. So kind of think of it this way. There's a show that's not for the children because it's a naughty show. So you got to watch it on TBS or TNT at Christmas time. It's called Trading Places. So nothing wrong watching it on cable or satellite, because they take the bad words out. But there's a great scene in Trading Places with Eddie Murphy. That film actually comes from the real story of the turtle traders. It's a really great trading story about the turtle traders, if you don't know about those. But Eddie Murphy, young William, right? Eddie Murphy gets a job for the Dukes as they're commodities brokers, and they put him in this nice house. And he can't believe it. He thinks he's being conned, which he is. And he says, "Oh, so this is my rug, and this is my TV, you're telling me. Oh, and this is my vase." And he grabs this vase and he starts playing basketball with it. He goes, "Oh, I could be like Meadowlark Lemon with this vase, right? This is my vase." And he drops the vase and it shatters. He's like, "Uh-oh." And the Dukes say, "Quite all right, William. It was your vase. Billy Ray Valentine, it's your vase." He says, "That's fake, right?" He goes, "No, I think we paid about $30,000 for it, but I think we put its value with the insurance at 50 or 45 or whatever. Oh, we paid $35,000, but we insured it for 50. You just made us $15,000. So he made money on the loss of value of the vase by buying insurance. And that's really how the guys in The Big Short made their money. They had insurance on CDOs, and when they went bad, they would collect the cash. They talked people into selling them insurance on collateralized debt obligations. When they fell, those insurance policies were worth $1 zillion, and that's how they made their money. In The Big Short during the subprime meltdown. So yeah, you can do those things, and that's sad because 401ks are not equipped for those hedges, and they're not equipped for those bearish strategies.
So when you say insurance, just for the new person that's listening, what do you mean by insurance? Can you go to State Farm and buy insurance, or how do we buy insurance?
Well, you buy insurance through put options. They're available at your brokerage, but there's a lot of other ways to do it. I mentioned the VIX trade. So I don't spend a lot of money on this. And I don't do it every time. If the VIX is high, I'm not going to pay for it. But the VIX is the volatility index, and it's based on the premiums people are paying for insurance on the S&P. So if I have a big fund and I'm extended out and I can't afford a big drop, then I'm going to buy some put options to protect myself. Mark Cuban, when he had Yahoo, sold calls to buy put options. He used the income from the calls he sold to buy the puts. So he actually had the market pay for his own insurance. Brilliant. And when Yahoo was destroyed, when their stock price was destroyed, billions of dollars are flowing into his pocket through insurance. Well, the VIX is a leveraged instrument. So let's say the VIX goes from 16 to 25. Well, that's a nice, jump in the VIX, but it represents hundreds of percent if you have options on it, because options are, times 100 shares per contract. So one of the things I'll do is I'll buy insurance when the VIX is really low. And that's Warren Buffett, be greedy when people are fearful and be fearful when people are greedy. So when people are greedy and the VIX is low, I'm a little afraid we might have a downturn. So I'll buy a little VIX. And then when that baby pops, it's pops. So when I buy the insurance on the VIX, it's a lot like car insurance. Okay, it didn't go anywhere. I lost the money that month. Oh, it didn't go anywhere. I lost the money that month. Just like I didn't get in a wreck, I paid my premium that month. Oh, my house didn't burn down. I didn't die, but I still paid my insurance premium. But man, when someone does get in a wreck or the house does burn down or someone dies, the payout is massive. And so I buy a little bit of insurance when the VIX. I only do it when the VIX is low. I'm not going to pay top dollar for VIX because when it's high, the crash has already happened. You're buying insurance that the house is already burnt down. So this is what we teach the Cash Flow Academy, right? We delve into all these details, and we help people learn how to get a base standard cash flow that doesn't matter on prices, but then also how to look at it opportunistically and have ways to make money in a down market if you want.
Now I love this. Now let's take it one step further. Sideways market, up, down, and probably sideways is neglected quite a bit. And this is probably where a lot of investors get trapped. So how do the wealthy keep earning in flat markets?
Well, behind me, I won't get it down, but on my shelf, I have something called a Galton board. And the Galton board has to do with probabilities, and it's basically a bell curve. And what's really nice is if you become an option trader and a net seller of options, sideways market can be actually the easiest and most glorious market in the world to get cash flow, because options are made up of time. And so it's like selling insurance once again. One of the more popular trades you got to be careful with is the iron condor, because they're so easy to do and they're such high probability. Thing of it is, if you don't know how to risk when they go bad, you can blow up your account. But that's a great example of a what we call a delta neutral, is what we call it, delta neutral trading, where we just think the delta isn't going to, this change in stock price is going to be there. So we go to what we call theta positive. Now, there's a bunch of jargon, so that's why we teach it. But basically, if you think of it as rent, let's say that the price of the house is stagnant. Well, the rent still comes in because the rent isn't based or attached to the house. The rent is per month. It's per unit of time. So I'm not selling a house when I rent it. It's got nothing to do with the house. I'm selling time is what I'm saying. It's always per month. When you buy insurance, it's time. And so one of the best ways in a sideways market, when prices aren't moving, time always moves. It always moves the same direction, and it always moves at the same speed. I got balloons coming up. I don't know why I hold up a 3 and a balloon comes up. What does 6 do? I don't know. But if you learn how to make money off labor, which is earnings, that's a dividend. If you learn how to make money off time, that's rent, where people have a contract with an expiration date on the contract. And when that contract expires, you do another one. So if you want to make money in a sideways market, learn about something called time decay, where you have a delta neutral. Another way you can make money is, I'm not getting into all the Greeks. Let's just leave it with that. Time decay is a great way to make money when a market's sideways. I'm getting wonky on everybody here.
All good.
I can hear Robert Kiyosaki in my ear screaming at me saying, keep it big picture, don't go in detail. And so I'm going to obey that voice.
I think the details are in the Cash Flow Academy to get really granular.
For sure.
If someone wanted to, and this is my final question here, if someone wanted to start learning these skills, and it's a good transition to what we just talked about, what's the first step? Where do they go?
There's a lot of ways to do that. There's a lot of possible first steps. You can go in a lot of directions. Here's one. The book Rich Dad Poor Dad is about what? Is it about assets and liabilities? Is it about financial education? Is it about taxes? Is it about the rich work to learn? Is it about the rich don't work for money? Or is Rich Dad Poor Dad a story of a man who found a fabulous mentor? And I think more than anything, that's what that book is. It's the story. It's a storybook. It's a story of a man who found a rich dad. So one of the first steps that I would take is say, who are the rich dads in my life? And if I don't have them, how do I find them and get to know them better? And I have great rich dads in my life. I have Robert, who was a massive rich dad in my life. Kim, rich. She's not old enough to be my mom. She's my, rich friend. I have Noah Davidson. I have Corey Halliday. I have name dropping all day long because I have people in my life. I get to speak to PhDs on my podcast, and I get to learn from these guys that are smarter than me. So I'd say the first step, who are the rich dads in your life? Who are they? Write them down. And when you write them down, how often do you interact with them? And how often do you learn something new from them? If you read Rich Dad Poor Dad 30 or 20 years ago, around 20 years ago, it's about how long it's been around, a little longer than that, then what have you learned since then? So I'd say that's one good first step. Who are your mentors? Find people that can help you. Another step is really easy. You always serve that up for me in every podcast. Go to Stockcom, download a book for free and start learning. So you can talk shop with this about, volatility or time decay or, asset building. It's a glorious education. It's so much more fun than I think than organic chemistry, but that's me. I like talking about money more than physics and stuff.
There you go. That's wonderful. I love it. Thank you for that. Listen, markets rise, markets fall, markets stall as well, but you don't have to be a victim of any of it. Once you learn the right strategies, you can build wealth in any environment. And a big thank you to Andy Tanner for breaking this down for us. Listener, if you're ready to start building those skills yourself, go to stockcastbonus.com right now. Get your free tools. It's time to stop hoping and start understanding. And if you like this episode, be sure to like it, hit a button, subscribe, share it with someone who thinks the market has to go up for them to win. Show them up, down, sideways. Listener, you're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.